Hey, welcome! Today, we are going to tackle one of the most powerful skills you can possibly have as an investor, and that's learning how to read a company's financial statements. We're going to pull back the curtain on the language of business and show you exactly how to find the real story that's hiding in the numbers. But let me just start with a question. What if? What if you could look at any company out there? I'm talking Apple, I'm talking Walmart, you name it, and truly understand its financial health. What if you could tell just by looking at a few documents if it's actually making money, if it's drowning in debt, or if it's generating real cash? Well, that's not some kind of superpower for Wall Street wizards. It's a skill, and you can learn it, and we're going to start building that skill right now. You see, the whole secret is locked away in 3 key documents. Every single publicly traded company has to file them. They are the income statement, the balance sheet, and the cash flow statement. If you can get your head around these 3, you've basically mastered the fundamentals of financial analysis. It's that simple. So here's the game plan for today. We're going to start with the income statement to answer the big question, is this business profitable? Then we'll jump over to the balance sheet to see what the company owns versus what it owes. After that, and this is the fun part, we're going to unlock some key financial ratios that are like a quick health check. Then we'll spend a little time decoding the cash flow statement, which is a super important tool. And finally, we'll wrap it all up and show you how to use your new investing superpower. All right, first up, the income statement. The big, simple, direct question this whole document answers is the business actually making any money? It's all about measuring profitability over a set amount of time, like a quarter or a full year. Everything, and I mean everything, on the income statement starts right here with revenue. Just think of it as the total amount of cash that comes into the business from sales. This is before any costs are taken out. It's always sitting right there at the very top of the statement, which is why I'll hear people call it the top line. Okay, to make this super simple, let's imagine Nancy's ice cream stand. Let's say in 1 hour, she sells $100 worth of ice cream. That's her total revenue. Her top line is $100. But of course, she has costs, right? The ice cream itself, the cones, let's say that's $70. That's her cost of revenue. So you subtract that and she's got $30 left over. But she's not done yet. She's got to pay taxes, say $10. And what she's left with at the very end, that $20, well, that's the most important number on this whole page. That number is called net income. You might also hear it called earnings. It's the bottom line for 2 reasons. 1, it's literally at the bottom of the statement. And 2, it's the number that really truly matters. It's the profit. It's what's left after every single expense has been paid. This is the money that can either go into the owner's pocket or get reinvested back into the business to help it grow. And here's the really cool part. This super simple model we just used for an ice cream stand, it works the exact same way for a giant global company. I mean, sure, the numbers are way, way bigger. We're talking billions of dollars. But the basic idea of revenue minus costs equals profit, it's exactly the same. So next time you go to a finance website like MSN Money and pull up a real income statement, you'll know exactly what to look for. You'll see total revenue right up at the top. And then you just scroll all the way down past all the different expenses, and you'll find that all-important net income number waiting for you at the bottom. Okay, let's move on to document number 2, the balance sheet. Now, if the income statement is like a movie showing performance over time, the balance sheet is like a photograph. It's a snapshot. It shows a company's financial situation at one single point in time. And it answers a really basic question. What does it own versus what does it owe? Let's go back to Nancy's stand. The balance sheet is split into 2 sides. On one side, you have assets. This is all the stuff the business owns that's worth something, like the cash it has in the bank or the physical ice cream stand itself. Then on the other side, you have liabilities. This is everything the business owes to other people, like a loan Nancy might have taken out to buy the stand in the first place. And this right here illustrates the most fundamental, most important equation in all of business. It's simply assets minus liabilities equals equity. This is the core logic of the whole balance sheet, and it always has to balance. So for Nancy's stand, the math is easy. She's got $10,000 in total assets. She owes $3,000 in liabilities. You just subtract one from the other, and you get $7,000. That number is her equity. So what is equity? The best way to think about it is it's the real on-paper worth of the business. If Nancy decided to sell everything she owned and pay back every penny she owed today, that $7,000 is what she'd walk away with. For a public company, you'll often hear this called book value. That's just the total equity divided by all the shares out there. Okay, so now we get the income statement and the balance sheet. But the real magic happens when you start connecting the dots between them. By grabbing numbers from both documents, we can create these things called financial ratios that act like a super quick health check on any company. So, one of the biggest dangers for any business, any investment, is debt. A company can get into serious trouble if it takes on too much. But how do you know how much is too much? Well, there's a fantastic little ratio that helps us answer that exact question. It's called the debt to equity ratio. And here's how you find it. It's really easy. First, you go to the balance sheet and look in that liabilities section. Find every single line that has the word debt in it. Short term, long term, doesn't matter. Add them all up. That gives you total debt. Then you just divide that number by the total equity, which you'll find right at the bottom of the balance sheet. And here's a great rule of thumb. A healthy, pretty safe company will usually have a debt-to-equity ratio below 0.5. That means for every $1 of its own money, it owes less than 50 cents. But, and this is a really important but, this isn't a hard and fast rule for every single industry. A big factory or utility company might need a lot of debt to operate, while a software company might have almost none. The key is to compare a company's ratio to how it's done in the past and to how its direct competitors are doing. All right, next up is the current ratio. This answers another really important question. Can the company pay its bills that are coming up soon? To figure this out, you compare two things from the balance sheet. First, current assets. That's all the stuff that's expected to turn into cash within the next year. And you compare that to current liabilities, which are all the debts that have to be paid in that same year. So you just divide the current assets by the current liabilities. If the number is greater than 1, that's a pretty good sign. It means more cash should be coming in over the next year that needs to go out. For example, a company like Johnson & Johnson had a recent ratio of 2.68. That's incredibly healthy. Now, here's the flip side. A ratio that's super high might mean the company isn't using its cash very well. And a fast-paced retail store might have a ratio closer to 1, since cash is flying in and out, and that's totally normal for them. Context is key. Okay, let's talk about our third and final document, the cash flow statement. Now, this one is a little more advanced, but it is so important. And here's why. Weird accounting rules sometimes let companies count a sale as revenue, even if they haven't gotten the cash yet. And net income can be affected by things that aren't actually cash expenses, so a company can look more profitable than it really is. The cash flow statement cuts through all that noise and just shows you where the actual, real money is moving. And this leads us to a concept that Warren Buffett loves. He calls it owner's earnings. It's his way of finding the true cash profit a business makes for its shareholders, and you find it on the cash flow statement. You take the line cash from operating activities and you subtract capital expenditures. Now, capital expenditures, or CapEx, that's just the money the company spends to maintain and upgrade its stuff, buildings, machinery, equipment, the cost of staying in business. What's left over is a much better picture of the real cash that business is spinning off for its owners every year. Whew, we have covered a lot of ground here, right? We've gone from the top line of the income statement to the bottom line of the balance sheet and a whole lot in between. You now have the basic tools you need to start analyzing any company. This is your new investing superpower. So let's just boil it all down into a super simple checklist you can use anytime. When you're looking at a company, just ask yourself these 4 questions. Number 1, from the income statement, is its net income positive and is it growing? Number 2, from the balance sheet, is its equity positive and is that growing? Number 3, is that debt-to-equity ratio safely below 0.5? And finally, number 4, is the current ratio sitting comfortably above 1.0? This is your starting point for a really solid analysis. And this is exactly why the skill is so crucial. As one of our sources put it, the financial statements are the heart of a fundamental analysis. With just these numbers, you can learn all kinds of things about an entity. You're not just guessing anymore, you're actually reading the story that the business is telling you through its numbers. Which really brings us to the final thought here. Every single company out there has a story, and it's written in the language of assets, liabilities, revenue, and profit. Now that you have the key, now that you can decipher that language, the only question left is, which of those stories are you going to choose to invest in?